Hello everyone and welcome to my channel. Today we are going to talk about a very important topic in economics: deflation. What is deflation? How does it happen? What are its effects on the economy and society? And what are some examples of deflation in history and today? These are some of the questions we will try to answer in this video. So what is deflation? Deflation is a decrease in the general price level of goods and services. This means that things become cheaper over time. You might think that this is a good thing, because you can buy more stuff with the same amount of money. But deflation can also have some negative consequences, as we will see later. Deflation is the opposite of inflation, which is an increase in the general price level of goods and services. Inflation means that things become more expensive over time. You might think that this is a bad thing, because you can buy less stuff with the same amount of money. But inflation can also have some positive effects, such as stimulating economic growth and reducing debt burdens. The rate of change in the price level is called the inflation rate or the deflation rate. When the inflation rate is positive, it means that prices are rising. When the inflation rate is negative, it means that prices are falling. When the inflation rate is zero, it means that prices are stable. So how does deflation happen? Deflation can be caused by different factors, such as a decrease in the supply of money and credit. Money and credit are the means of payment in an economy. When there is less money and credit available, people have less purchasing power and demand for goods and services falls. This leads to lower prices. An increase in the supply of goods and services. Goods and services are the things that people buy and sell in an economy. When there is more production and innovation, people have more choices and competition increases. This leads to lower prices. A decrease in the demand for goods and services. Demand is the willingness and ability of people to buy goods and services at a given price. When people have less income, confidence, or expectations, they tend to spend less and save more. This leads to lower prices. These factors can interact with each other and create a feedback loop that reinforces deflation. For example, when prices fall, people expect them to fall further and delay their purchases. This reduces economic activity and income, which lowers demand and prices even more. This is called a deflationary spiral. So what are the effects of deflation on the economy and society? Deflation can have both positive and negative effects, depending on its magnitude, duration, and context. Some of the possible effects are positive effects. Consumers benefit from lower prices and higher purchasing power. Savers benefit from higher real interest rates and lower inflation risk. Debtors benefit from lower nominal interest rates and debt service costs. Exporters benefit from increased competitiveness and market share. Negative effects. Producers suffer from lower profits and revenues. Investors suffer from lower returns and asset values. Creditors suffer from lower nominal interest rates and debt repayment values. Workers suffer from lower wages and employment. Deflation can also affect the monetary policy of central banks, which are the institutions that control the supply of money and credit in an economy. Central banks usually try to maintain a low and stable inflation rate, which is considered optimal for economic growth and stability. However, when deflation occurs, central banks face some challenges. The zero lower bound problem. Central banks cannot reduce nominal interest rates below zero, because people would prefer to hold cash instead of depositing money in banks or buying bonds. This limits their ability to stimulate the economy by lowering borrowing costs. The liquidity trap problem. Central banks can increase the supply of money by buying bonds or other assets from banks or the public. This is called quantitative easing, or QE. However, when people expect deflation to continue or worsen, they may hoard money instead of spending it or lending it out. This reduces the effectiveness of QE in increasing economic activity. So what are some examples of deflation in history and today? Deflation has occurred in different times and places around the world, with varying degrees of severity and duration. Some of the most notable examples are the Great Depression of the 1930s. This was a period of global economic crisis characterized by widespread deflation, unemployment, and poverty. The main causes of the Great Depression were the collapse of the stock market in 1929, the contraction of the money supply due to bank failures, the trade wars and protectionism, and the lack of fiscal and monetary stimulus. The Great Depression lasted until the late 1930s or early 1940s, depending on the country, and was only ended by the outbreak of World War II, the Japanese lost decade of the 1990s. This was a period of economic stagnation and deflation in Japan. following the burst of the asset bubble in the late 1980s. The main causes of the lost decade were the high levels of debt and bad loans in the banking sector, the lack of structural reforms and innovation, and the insufficient fiscal and monetary stimulus. The lost decade lasted until the early 2000s and was followed by a period of low growth and mild deflation, known as Japan's lost spore. The Eurozone crisis of the 2010s. This was a period of economic turmoil and deflation in some countries of the Eurozone, especially in Southern Europe. The main causes of the Eurozone crisis were the sovereign debt crisis, the banking crisis, the fiscal austerity measures, and the lack of monetary policy coordination. The Eurozone crisis peaked in 2012 and was partially resolved by the intervention of the European Central Bank and the creation of the European Stability Mechanism. However, some countries still face low growth and deflationary pressures. The COVID-19 pandemic of 2020 to 2021. This is a period of global health emergency and economic recession caused by the outbreak of a novel coronavirus. The main effects of the COVID-19 pandemic are the lockdowns and social distancing measures, which have reduced economic activity and demand for goods and services. This has led to lower prices for some commodities, such as oil and metals, and for some sectors, such as tourism and hospitality. However, some prices have also increased due to supply disruptions and higher demand for some goods, such as food and medical supplies. Therefore, the COVID-19 pandemic has resulted in a mixed inflationary-deflationary scenario. So this is all for today's video. I hope you learned something new and interesting about deflation. If you liked this video, please give it a thumbs up and subscribe to my channel for more videos on economics and other topics. And don't forget to leave your comments and questions below. Thank you for watching and see you next time.